Good morning and welcome, everyone. Thanks for attending today's webinar. Can everybody hear me okay? I'm going to unmute you for 1 second just to make sure we're not having any. All right. Is everybody there?
Yep.
We've got quite a few attendees here this morning. I'm going to go ahead and get started today. Thank you for attending today's webinar. My name is Jo McClure, and I'm the Director of Payroll Administration at ACCET. I do see some familiar names on the list of attendees, so I'm excited to have you joining us today. And also with me today is Beth Folk, who's from our marketing team. She'll be monitoring the webinar, and she'll be helping with any logistics or tech support. Before we get started, we're going to cover a few housekeeping items. So today's presentation will last approximately 20 minutes, which is not a lot of time to go through this topic, but we'll do the best we can. We will be recording this webinar, and you'll receive a link to review the information again if you like. I am going to go ahead and mute everyone's phone. So if you have any questions, please just use the chat button. It is on the top left-hand side of your screen. We're going to jump right in and talk about the Payroll and Tax Cuts and Jobs Act. So on December 22nd of 17, H.R. 1, which is unofficially known as the Tax Cuts and Jobs Act, or TCJA, was signed into law. And this act marked the most sweeping tax changes in 30 years, and it has, of course, and it will continue to impact payroll professionals in 2018 and then beyond, because most of these changes will remain in effect until the end of 2025. Of course, they took effect 1/1/2018 and some retroactively. The act made changes to the tax law, including increasing the standard deduction, removing personal exemptions, increasing the child tax credit, limiting and discontinuing certain deductions, and of course, changing the tax rates and the brackets. So today, we are going to focus on just a few pieces of the law that really most greatly impacted payroll. We'll talk about the 2018 federal income tax withholding tables, the 2018 Form W-4, and fringe benefits. All right, so as a first step to reflect the tax law changes, the IRS released new withholding tables, and they did that via Notice 1036 in January. These tables were designed to produce the correct amount of tax withholding, avoiding over and under withholding of tax for those with really simple tax situations. They're designed to work with the W forms that employees already had on file with us, which is great because that minimized the burden to everyone, to us and to employees. And this also means that people with simple tax situations might not need to make any changes to their W-4s. Simple situations kind of include singles, married couples with only one job, who have no dependents, and who have not claimed itemized deductions, adjustments to income, or tax credits. However, people with more complicated financial situations might need to revise their W-4s. And among the groups who should check their withholding are two-income families, people with two or more jobs at the same time, who only work for part of the year, people with children who claim credits such as the child tax credit, people who itemize deductions in 2017, and people with high incomes and more complex tax returns. And with the new tax law changes, it's especially important for these folks to use the withholding calculator that's available on the IRS site, irs.gov, because that'll help them to make sure that they have the right amount of withholding. But we'll talk about that too a little bit more in detail in a moment. All right. So the 2018 Circular E, or Publication 15, was released with a publication date of January 25th of 2018, and it restated the 2018 percentage method tables, and it included the wage bracket method tables for income tax withholding, which incorporate those changes to the individual tax rates based on the TCJA. Notice 1036 also covered the changes to supplemental wages. So supplemental wages were reduced to 22% from 25%. They were also reduced to 37% from 39.6% when those supplemental wages exceed $1 million in a calendar year. I tried to dig around. I didn't even wasn't able to find out or confirm how long that supplemental wage rate had been 22%. But I am very glad that I'm not taking my CPP exam this year, because that would be a hard thing. That's been a hard thing to remember and get in the front of our mind, that change that supplemental rate. One of the first things we tried to do was make sure our software was addressed all our earnings codes that were supplemental earning codes that we had flagged to tax appropriately. So that was one of the first changes we had to make, and look back and see what had been paid out year to date. This also included instructions to calculate the amount of income tax to withhold from the wages of non-resident alien employees performing services within the United States. And this guidance also gave an implementation deadline, said that they wanted us to load these tables as soon as possible, but no later than February 15th of 2018. So hopefully everyone is working with updated tables at this point. All right, so on to the 2018 Form W-4. And the really good news is that the IRS is not requiring employers to obtain new W-4s from their employees. The not so good news, or the other news, is that the bulk of the change is to the instructions in the worksheet, making it a 4-page form now. So hopefully it doesn't get as long as the I-9 instructions at some point. The new W-4 instructions and calculations attempt to get individuals closer to their tax liability. So for example, under the calculating personal allowances section of the 2018 W-4, the IRS removed the reference to dependents who you can claim on your tax return. They changed the calculation for the child tax credit to reflect the new amount and the significant increase in the phase-out amounts. And they added the credit for non-child dependents to factor into allowances. And then under the changes to deduction, adjustments, and additional income worksheet, the IRS changed the estimate of itemized deductions to reflect the new tax law referencing the 10K cap on state and local taxes, including property and income taxes, and the change to medical expenses in excess of 7.5%. The wage thresholds and the amounts for the two earners multiple jobs worksheet were updated to reflect the dynamic of the new tax code on these taxpayers as well. Okay, so the changes to the part of the form the employee completes outside of that worksheet were pretty minor. There were some verbiage removed from box 3. So you'll see on the slide that the 2017 form notes in box 3, if married but legally separated or spouse is a non-resident alien, check the single box. Well, in box 3 on the 2018 form, it notes if married filing separately, check married but withhold at higher single rate. There was also some verbiage change in line 5. The 2017 form, it referenced line H of the worksheet, so that's been removed to reflect the correct worksheet information on the 2018 form. One thing you'll want to consider if you haven't already is, are you using an electronic onboarding system? If you are and you use kind of a TurboTax feel where you're going through questions and answers, has all that information been updated to reflect the new form yet? Do you have new hire kind of packets or materials that you have that you just pull out whenever you hire someone new and make sure that you've got the form updated there? Or do you have self-service sites for your employees where they can either access the form? If so, do you have the new form out there for them? Or are they actually able to make changes to their W-4 online? And if so, is that system now set up to reflect the changes in the new form? All right. So we're also going to talk about the fields that changed for the employer section of this form. Box 8 is still reserved for the employer's name and address, and your employer identification number must still be entered in box 10. However, there's a new field for box 9. Instead of the optional office code field that was on the form, box 9 is now used to report the worker's first date of employment with your company. This change was designed to help employees meet state child support requirements for new hire reporting. According to the 2018 instructions for the form, when you're completing Box 9, the first date of employment is the date the worker first performed services for payment at your company. If an employee was rehired after at least 60-day separation, then the rehire date is what you need to put there instead. So to go along with the change to Box 9, the text in Box 8 now instructs employers to fill out 8, 9, and 10 when submitting the form to State Directory of New Hires, and the address listed in Box 8 must be the location where those child support income withholding orders should be sent. Okay, so your employees probably have already come to you in a lot of these situations and will continue to. So let's talk about how we help employees through these changes. First and foremost, just being prepared for questions and requests. With all the attention the new W-4 form has been getting, you're going to be fielding, like I said, you probably already have, but you'll be fielding more questions from employees. So be prepared to provide them, with their information from the Form W-4. They may be asking for copies, and they may be asking for their most recent pay stubs. Even better yet, maybe providing an overall communication that if those things are available to them via like an employee self-service site, online, or through like an intranet, providing them a communication about the changes and how they can access that information on their own if possible. You're going to have some folks that really appreciate that, and the ones who aren't interested in that will come to you anyway. So, but it's a good plan to go ahead and get in front of it and allow that for those folks who really do want to dig in and get their own information. That just need to remember how to do that. Also, you want to make sure that you're kind of ready to implement any withholding changes that the employees submit as soon as possible so that you'll be well within the 30-day period required by the IRS. Per Publication 15, an employee who experiences a change of status that causes a reduction in the number of withholding allowances isn't required to give you a new W-4 until 30 days after the 2018 form is released. And the date that I've been working from is the February 28th. That was, I believe, the earliest date that I have found when that form was available. So they basically have till roughly the end of March. An employee that has a reduction in the number of withholding allowances solely due to changes from TCJA isn't required to give you a new form during 2018, but they can do so at any time. They can use the 2017 form, so if someone has that form and they complete it and they bring it to you, you don't need to make them use the 2018 form instead until, 30 days after, since the new form has been released. So you can accept those 2017 forms until roughly, March 28th. New employees may continue to claim allowances on that form, and then anyone who has given you, of course, a 2017 form for updates so far this year, you don't need to have them give you an 18 form now. They don't have to resubmit that. Okay, you might also want to direct employees, we talked about this a moment ago, to that new IRS calculator so they can estimate their tax liability. There's a link on this slide, and we'll be sending you the presentation afterwards so you can use that there. The IRS encourages employees to use that withholding calculator to perform a quick paycheck checkup. They actually, just yesterday, I received an email from our local IRS senior stakeholder liaison about their new campaign. They have a new Thunderclap. Thunderclap is a social media platform that will automatically post a message on your Facebook or Twitter or Tumblr account to support an initiative, and the IRS has one out there supporting an initiative to drive folks to this withholding calculator. So I am happy to forward that to anyone who wants that email from the IRS liaison. It's pretty helpful, so I'm happy to send that your way. There is a link also on this slide to that Thunderclap campaign. Okay, the other thing about the site and the new withholding calculator is that it's really helpful on what tips those employees should have, what they should have in front of them before they log in and begin the calculator. What do you need so you can get this all entered right now. It also really reassures them about what the IRS would do with that information that they enter into that calculator and how that's used or not used. All right. We're going to jump ahead. Exempt W-4s, and we're running pretty short on time, so I'm not going to go through all these bullet points. Most of you have probably already addressed your exempted W-4s, And there was a lot of different ways you could address them, clearly, from this slide. So if you haven't addressed those yet, you might want to review these. Of course, the deadline got extended to the 20th of February instead of the 15th of February. All right. We're going to jump to fringe benefits. One of the challenges that we've really faced in this area is that the IRS needs time to review and implement the required changes. They needed that time. So what happened is that we ended up with an implementation period, as we did back in 2009 when the new tax legislation was passed back then. So in the area of fringe, we continued to use those 2017 charts and guidance until the information was clarified. And this created some issues. Some of the fringe benefits we offered had tax status changes from non-taxable to taxable, and we hopefully all tracked those payments so that they can be properly taxed now that we know how we have to do that. We also, on our side, had to make adjustments to our codes, our earnings codes, our reimbursement codes. In some situations, we just created brand new ones so that we could truly reflect the change in taxation, and we would know, okay, if this code was used, this is an employee, who had this situation. A few of those we'll dip into real quickly is the moving expenses. One issue that came up concerning the change to reimbursement for moving expenses, the new law said that their value could no longer, of course, be excluded from the employee's income. So if your company reimburses expenses for moves in 2018, the law is clear that those are now taxable. But the question came up, what should we do for an employee who moved at the end of 2017 but wasn't reimbursed until the beginning of 2018? So that's when the reimbursement happened. And the IRS experts have answered this question. They did that during an APA presentation at the 2018 Capitol Summit in Washington, D.C. They said that moving expenses incurred in 17 and paid in 18 must be treated as income. So that means you might need to go back, withhold the proper amount of tax from these payments. And in these situations, you likely have already had a conversation about gross up if your company is going to go ahead and just gross up those wages to cover those taxes, since when the employee moved, this wasn't set in stone yet. So that might be something you're considering. The other change that likely doesn't affect too many folks around here, but was that some of the transportation deductions, so bicycle commuting benefits, are now included in wages subject to taxes. And again, it's going through that conversation saying, how are we handling this? Are we taking the benefit away? Are we keeping the benefit in place? Are we just going to go ahead and gross up those taxes and pay those on behalf of the employees? And when you do that, just keeping in mind that that amount that you've grossed up to cover that becomes taxable as well. All right, a few minutes over time. I'm going to jump in real quick and wrap this up. There's a few more pieces that we didn't touch on today, and of course there's a lot more to it. But in terms of payroll, I wanted to make sure we talked a little bit about the decrease and loss of business deductions. There's some bullet points of areas that where that happened. Federal tax levies. The amount exempt from the levy no longer takes into account personal allowances, so hopefully that's something you've addressed. Also, the U.S. citizen born earned income, if anyone's dealing with that, that was reduced to $103,900 from $104,100. And then the tax reform law also created some late-in-the-game updates to the 18 tax-free contribution limits for employees' HSAs if they had family coverage under a high-deductible health plan. The IRS reduced the limit to $68,500 down from $6,900. And so I know internally we really had to do an audit, to see how many of our employees had elected that maximum contribution, and then what system changes do we have to do? We made a system at the global level in our payroll system, but we also had to look at the employee levels to see how they had elected to make those contributions. And we had to assess, we did have some folks that who had in the very beginning of the year maxed that out. They'd already made the full contribution. And so we were able to work with our HSA administrator who was able to send that $50 back, and then we were able to refund that through payroll so that they weren't liable for additional taxes, and their year-end reporting will report the correct limits. All right. So I just wanted to thank you for everyone for attending today's webinar, researching, communicating, and implementing changes due to wide sweeping legislation like this or like ACA, all those kinds of areas is just one of the things we help our clients with on a daily basis. Again, I'm with Active HR Solutions. We've been in business. We're celebrating our 30-year anniversary. So if you are facing challenges in those areas, payroll, HR, employee benefits, risk management, we would love to talk to you more. Thank you again, everyone, for attending.